welcome to the very first episode of Young and Leveraged. Young and Leveraged is a platform, a podcast, where us, finance students, will discuss and debrief financial news for you guys. So as we go along, keep following us and giving us your feedback, of course. For today's episode, however, we will focus on P ratios. As you guys might have observed, P ratios have been increasing in the past decade or so. This has been due to, I believe, because of AI companies, P ratios have been on the rise. And today we will discuss two companies, Palantir and Petmed, which have incredibly high P ratios, joined by Avnish and Mokshada. Avnish will lead us on Palantir, and Mokshada will lead us on Petmed. So I can see you're very happy to be here.
I speak for itself.
And it has been, I can tell you guys, it has been quite a journey to bring this podcast to you. How are you feeling?
Yeah, I'm feeling great. Why wouldn't I be? When I look at Palantir, things are looking great on paper, at least. Things in the green, at least whenever we look at its financials. And yeah, I'm happy to begin whenever you give me that.
Okay, so let's begin. Let's get straight into the subject. Yeah, tell us a bit about Palantir.
So it began as a spyware software for the US government. Its main idea was to help in data organization, which could then help the US government to combat terrorism. In terms of product offerings, it's got a really huge range spreading from COTAM to AIP. AIP is a platform which enables natural language queries, and it has had multiple companies, and it has even signed a licensing agreement with Fujitsu in Japan to integrate that system in its framework. Maybe a quick glance at its competitive landscape, but it has a great advantage because it offers a full stack integration compared to other big tech players like Microsoft and Google. But Palantir is here to offer you that full inclusive system that will help us drive better decisions.
Indeed. And what I really like about this system, AIP, that you're talking about, it can really be applied to any case or scenario. To then to be used for analytic, for data analysis. And this way, Palantir can really diversify its revenue stream. For instance, it has contracts, it has secured contracts with the US government, which relates to war and arms production. And in that sense, it can also provide more analysis to other scenarios. For instance, if there's a recession, then Palantir is there. Or they can also analyze the operational efficiency of other companies. For instance, I believe they did that for either Boeing or Airbus. It proved to be efficient and successful. So in this way, Palantir can really grow since it has this ability, I would say unique ability, to diversify its revenue stream way, way further.
Yeah, clearly. That what have you been saying is evidence when we talk about its financials. But you raised a great point when you refer to the contracts, because I think that's going to drive a sticky revenue base, which will translate into better margins and really high margins, actually, margins of 80%. So what does that mean? It's simply telling you that whenever Palantir services an agreement to a customer to supply its software, it's actually able to convert 80% of its revenue into profits. And that's massive. And I think that's just explained by the strong operational leverage. So a great component of its expenses are derived from fixed costs. So that's helping to really inflate return on capital employed. I've got the figures 44.7%. And for a company that has just started growing, I think we can agree on that. It's impressive.
So let's dive a bit into the P ratio. Tell us, why is it that high?
Yeah, that's the thing. So we've got two sides of a story. One which tells you about market sentiments. Investors are just overhyped about Palantir. And I think maybe you mentioned that at the start, that whenever it concerns AI, seems to always be that booming effect in the investor psychology. And I guess that's something that we cannot really control. So that's the first part of it. And the second element is the strong fundamentals. I mean, everything here is just looking great. I did not raise that earlier. Free cash flow of $1.7 billion. So when free cash flow is that high, it means that the company has massive potential, for example, for acquisitions, targets, and really further diversification. So it's got everything. And I guess these two elements intertwine together. So it's really complex. And I think that's the interesting part of today's discussion. It's complex to actually isolate both elements to see which has the upper hand. But from my own personal opinion, I guess it's really sentiments that's taking the upper hand.
Yeah, so like you mentioned, I think you phrased that very well. People think that Palantir has really got everything right now, and following the dot-com crash and everything, we tend to think maybe it is true. Like you said, it is very overhyped, and now given that Trump is helping to increase that hype through its budget for super AI and whatnot. So given all this, I would say that it is just a point right now on that growth curve. It has not reached a complete success. So what is your point of view concerning?
Yeah, so I guess that can be approached using the valuation metric, so the P ratio, which is the crew of this episode. So its current P ratio is around 555.80. That means that to be able to deliver on promises that Palantir is making for investors, it has to generate consistent returns of about 50 to 60% on an annualized basis for at least 10 years. I think that's quite unreasonable when we factor in risks like geopolitics and economic downturns. So from my understanding, Palantir is priced for perfection. It leaves no error, no margin for errors to be made. As soon as it misses any sort of target, I think we are expecting to see a really great crash in its stock price.
Indeed. And price for perfection, too soon. Too soon. Yeah. So I believe, as you said, fundamentally, the company, Palantir, is really good. The fundamentals are great, but at the price it is currently trading, it's a bit of a stretch. It's a bit too much. And for us, if you're taking our case, students, it's not worth putting our money into that and taking such risk. So we can put it really high on our watch list, and let's wait and see what happens. If there's any sort of recession or a severe market, then definitely we can go and buy Palantir. But for now, let's just wait and not take too many risks.
Because, like you said, back January, it was priced around $70, and it's now trading at $166. So that's about a 131% rise in its stock price. So, like you said, let's just wait till something better happens that calms down those values.
And Mokshada, do you agree with that?
I mean, such a substantial increase in so little time, definitely not for us risk-averse investors, especially like you mentioned, students.
Yeah.
We are what we could define as maybe broke according to Gen Z. So let's just wait and see what happens.
So let's move on to Petmed now. What's going on with that company, Mokshada?
Yeah, so just a little explanation for people who don't know what Petmed is about. I mean, the name says it all. It's pet medications, right? You have bullet plus supplements, diabetes, chemo medications, everything you can think about for animals. Recent disclosures and developments that have happened is that it actually filed its 10K form very late, to the point that NASDAQ actually had to file a deficiency.
It's really bad.
Yeah, I think it will go worse.
It just gets worse. You just wait for that. Preliminary results show you that sales have gone down from $66.5 million to $53 or $55 million. And it just goes down in the sense that, how did that happen, right? So expenses were really eating away at the revenue. You have expenses in terms of G&A, customer acquisition, advertising. Now, all these were supposed to attract new customers. But fun fact, you have the old customers that are just saying goodbye as well.
Yeah, the competition is really harsh. We live in that sphere. We have Amazon, which are really, really strong. As you are saying, it's difficult for Petmed to survive in that kind of an environment.
I think what's a really big shame here is that even though the competition is there, it has certain licensing rights, which it's not exploiting actually. So instead of actually capitalizing on those and maximizing its revenue, it's not doing that. Instead, it's going the exact other way around.
Yeah, exactly. That's the point. Like you see Amazon, Walmart, and Petco, Chewy, they all have been using AI technology in general to their advantage. And like, come on, you have Palantir on the top of the list. You can't tell me that Petmed can't see how AI is being hyped right now. But instead, it is just going to spend on traditional advertising stuff. It is not even trying to build veterinary clinics around the world that could create an outlet for those medications directly. So it's just going downhill at this point. I mean, the only positive here is in terms of liquidity, the $55 million in cash with no debt and a current ratio of 1.3, which is quite satisfactory, I guess. What do you guys think about that?
I mean, I am all in for holding cash, and it does work, but it works when you're actually doing great and just keep a buffer. But in that case, as you said, it's really not working at a corporate level itself. So the excess cash, I don't think that would be of any great use as such.
Yeah, and I think maybe, I know you said that it's going down, like it seems that there's nothing that could prevent its ultimate downfall, but I will.
Maybe you're a bit too harsh.
Maybe we are really harsh right there, but I think some sort of financial restructuring might keep that company afloat, because from a moral perspective, what it's doing for animals, it's great. So why should it stop existing? Some sort of maybe even management reshuffling. I'm not sure if you agree with me, but I guess it had certain management issues, right?
Yeah, so like you say, restructuring, maybe acquiring better employees, skilled, and maybe more of the Gen Z. Why not? Because they know much more about technology. They have better recommendations for this generation and the new type of sales marketing, whatnot, right? So the thing here is, ironically, they are doing the exact opposite. They're actually laying off employees. So you see that maybe the wage per employee, is super high, but that is not attributable to employing more people in the total wage. It's not about that at all.
Yeah, and I think that sort of management structure can really be contrasted with Palantir. The CEO, Alex Carr, is visionary. He's got something that's contrarian for sure. He's not trying to replace the easy, cheap substitutes of AI that are available, the traditional chatbots and whatnot. But he's there to redefine what it means to be able to provide something world-class in analytics. And I guess that sort of philosophy is what drives a company to success.
Indeed, and that's totally what Petmed is really thinking with. Yeah, but that is hope. You never know in the world. That's hope for Petmed. So on that, we conclude, right?
Yep.
So my take on what we have discussed as students or investors in general, we should be careful when analyzing key financial metrics such as the P ratio. We've seen here that both companies have incredibly high P ratios, but for completely opposite reasons. Palantir, the high P ratio is explained by incredible and tremendous growth, and for Petmed, it's the complete opposite. It's literally because the earnings are so low that the P ratio is high.
I think there's a fundamental difference between value and growth investing. Whenever growth is, like you said, you raise that point, it could be a particular point in let's say, life cycle of Palantir that it has reached. So whether it can actually surpass, definitely will surpass, but to what extent, to what rate of growth will it be able to deliver? That's a big question here, and that's reflected in terms of valuation concerns. Although Wall Street banks, for some reason, are really optimistic and are recommending it as a strong buy, but value is just not debatable. Whether we think of value investing, it's based on that philosophy of having that discipline and that mindset of actually waiting for that right time and being patient. And I guess that's the sort of investment philosophy that we youngsters are going to adapt whenever we start exercising in our career. So yeah, I guess that's my take.
Yeah, I mean, he kind of summarized it all. I don't have much to say about it, but of course, you have that correlation between value and growth, and value is supposed to tell you a lot, especially if you are looking at fundamental analysis, right? But the thing here, there are a lot of factors to consider, especially when it comes to companies like Petmed. You are not going to let your animal die just because there's a recession. Maybe it might be the case for some, I don't know, but point is, there are a lot of factors that play a role in this, and you just have to analyze and see according to the companies, right? For example, like he said, for Palantir, there are specific factors, and for Petmed, specific ones, but the company itself is not considering it, so the investors will be pessimistic about it all.
So yeah, guys, that's about it. I think we touched everything that we wanted to talk about P measures, and thank you very much for being here.
Thank you for bringing that.
Yeah.
Really encouraging.
Thank you.